October 29th, 1929, Black Tuesday. The stock market crashed 12% in a single day, triggering the Great Depression, the worst economic disaster in American history. Over the next 3 years, the market lost 89% of its value. But here's what's keeping Wall Street analysts up at night in 2026. There's a specific chart pattern that appeared in the months before the 1929 crash, a pattern so reliable that when it shows up, professional traders pay very close attention. That pattern just appeared again. And in this video, I'm going to show you exactly what it is, and why some of the smartest people on Wall Street are quietly preparing for what could come next. Value proposition. By the end of this video, you'll understand the three-phase pattern that preceded the 1929 crash, why it's appearing in the charts right now, and what the historical timeline suggests could happen in the coming weeks. Let's look at what happened in 1929, what the pattern was, and where we are today. The 1929 timeline. Most people think the 1929 crash came out of nowhere, that the market was fine and then suddenly it collapsed. But that's not what happened. The warning signs appeared months before the crash. Here's the timeline. Early 1929, the euphoria phase. The stock market had been in a massive bull run through the 1920s. People were borrowing money to buy stocks, buying on margin. Speculation was everywhere. The idea that stock prices could fall seemed absurd. Investors believed in a new era of permanent prosperity. The market had gone up for so long, people couldn't imagine it going down. Summer 1929, the warning signs. Starting in June and July 1929, something changed. The market plateaued. It would rally, but each rally was weaker than the last. Volume patterns shifted. Heavy selling on down days, light buying on up days. Most investors ignored these signs. The media was still bullish. Experts said, buy the dip. September 1929, the pattern completes. In September 1929, a specific technical pattern formed. It's a pattern that appears before major crashes. I'll explain exactly what it is in a moment. October 1929, the crash. October 24th, Black Thursday, the market crashed. October 29th, Black Tuesday. The market crashed even harder, falling 12% in a single day. Over the next 3 years, the Dow Jones fell from a peak of 381 to a low of 41. That's an 89% decline. The pattern that formed in September gave professional traders a warning, not weeks before the crash, but enough time to reduce exposure. The pattern explained. So what was the pattern? It's called a distribution top. Let me explain what that means. Phase 1, the final rally. In the months before a major crash, you often see one last dramatic rally. Prices spike upward, volume is high, everyone rushes in because they don't want to miss out. This happened in summer 1929. The market made new all-time highs. Euphoria peaked. Phase 2, the reversal. After the final rally, the market can't sustain the high prices. It starts to roll over, but it doesn't crash immediately. Instead, it makes a series of lower highs and lower lows. This is the distribution phase. Large investors, the smart money, are selling, but they sell slowly so they don't crash the market all at once. You can see this in the volume. Heavy volume on down days means selling pressure. Light volume on up days means weak buying. Phase 3, the break. Eventually, the market breaks below a critical support level. This triggers panic selling. Everyone who was waiting for one more rally gives up and sells. That's when the crash happens. In 1929, this pattern took about 3 to 4 months to complete. From the final rally in summer to the crash in October, this pattern appeared before 1929. It appeared before 1987, before 2000, before 2008, and it's appearing again now. Why Wall Street is watching now. Here's why this matters for 2026. Look at the current market overlaid with the 1929 pattern. Phase 1, the final rally, complete. Late 2024 through early 2025, we saw a massive rally. AI stocks were soaring. The market hit all-time highs. Euphoria was everywhere. Everyone talked about a new era of AI-driven growth, just like 1929's new era of prosperity. Phase 2, the reversal. In progress. Starting in mid-2025, the market plateaued. We've seen several rallies, but each one has been weaker than the last. Lower highs, lower lows. The volume pattern shifted. Heavy selling on down days. Weak buying on up days. This is the distribution phase. Institutions are selling. Phase 3, the break, approaching. We haven't had the final break yet, but we're approaching critical support levels right now in early 2026. If these support levels break, if the market falls below certain key prices, it could trigger the same cascade selling we saw in 1929. The market doesn't have to crash. This pattern doesn't guarantee a crash, but it tells us we're in a high-risk environment. Wall Street is nervous because the last time this pattern appeared with this level of clarity was 2008. Before that, 2000. Before that, 1987. And before all of those, 1929. What makes this different? You might be thinking, we're not in the 1920s anymore. We have the Federal Reserve. We have circuit breakers. We have regulations. That's true, we do. But here's what makes the current situation potentially more dangerous than 1929. Leverage. In 1929, people were buying stocks on margin. Today, we have even more leverage in the system. Derivatives, options, leveraged ETFs. Margin debt is at all-time highs. Valuation. In 1929, stock valuations were extremely high. Today, they're even higher by some measures. The price-to-earnings ratio of the S&P 500 is in the top 5% of all-time readings. Complacency. In 1929, nobody thought the market could crash. Today, after 15 years of the Federal Reserve intervening every time the market falls, investors have become complacent. They expect the Fed to save them. But the Fed's power is limited. Interest rates are already elevated. They can't cut rates indefinitely without reigniting inflation. When this pattern completes, when we get the final break below support, the cascade could be faster and harder than people expect. That's why Wall Street is paying attention. Not because the 1929 pattern guarantees a crash, but because it shows we're in the same kind of setup that preceded the worst crashes in history. Disclaimer. This is educational analysis of historical patterns and current market structure, not financial advice. Call to action. If you're invested in the stock market right now, you need to understand the risk environment. We're not in a normal market. We're in the kind of environment that appears before major crashes. That doesn't mean a crash is certain, but it does mean preparation matters. Do you have a plan if the market falls 20%, 30%? Are your stop losses in place? Do you have cash reserves? If you want the next update when support breaks, subscribe. Drop a comment. Do you see the 1929 pattern, or do you think this time is different? Thanks for watching. Check out the video on screen about the 1987 pattern. It's the same signal showing up in a different time period. I'll see you in the next one.